Okay, so we're going to talk a little bit more about inventory in this chapter. So here's the problem. So like I grew up in a store, and I think I told you guys we had to like go out there and like count and do this inventory every year, and it was this big hassle. And so now we have perpetual inventory systems that use barcode scanning. So in essence, every time we add inventory, we can just scan inventory in and say we have this much, and then each time we sell something, it just gets taken out of inventory, which is pretty awesome. But there's still this question, like, so if I think the example I used before was like cans of peas. If I buy a case of cans of peas as a store, and it has 12 cans in it, and I pay 90 cents per can, and let's say I'm marking it up to, say I pay 50 cents a can, and I'm marking it up to $1 to make our math easy. And then before I sell all those cans of peas, I order more cans of peas, and this time there's been a price increase from the supplier, and these ones cost 55 cents a can, but I'm still going to sell them for $1 because it's still within my target profit range. And then I buy a third case of peas, and they cost 45 cents a can. And so the SKU, or the barcode on each of those cans of peas, is identical. Okay, so the question is, when I go to tally up my cost of goods sold, how do I know which cans I sold? Did I sell the ones that cost me 50 cents, or the ones that cost me 55 cents, or the ones that cost me 45 cents? In a perfect world, I'd have my, I'd put them on the shelves, and with the oldest ones at the front, and then the newest ones at the back, and the customers. But you've been to Walmart, anybody ever worked in retail, you know that people go like rummaging and digging, and like, this one's the perfect one. They're all the freaking same, lady. Just take one, right? But that happens. And so how do you know which cans of peas you're selling as far as from a cost perspective? Remember, we track inventory on our records at its cost, and we track cost of goods sold also at its cost. And so because we can't really know, like, it's almost impossible to know exactly which cans of peas, and then think of something the size of a single Walmart store, and then think of something the size of Walmart, all the Walmart stores together, and they're supposed to somehow keep track of which can of peas or which bottle of shampoo or whatever that they sold, becomes really difficult. So instead, what we do is we use what's called cost flow assumptions. And there's like 4 main ones, but there's others, but we're going to learn about 4 different types of cost flow assumptions. And what you do as a business is you decide, hey, this is how we're going to estimate which units we sold and which units are still sitting there in inventory at the end of the accounting period. Okay, so the first is what's called first in, first out. Sometimes people call it FIFO, sometimes people call it FIFO, sometimes people say fee fi fo fum, but that's from that smell of the blood of an Englishman thing. What I hate about that rhyme? Did I ever tell you that like rhyme when you were a kid? Be he alive or be he dead, I'll grind his bones to make my bread. That seems horrible to me. And I don't know that I'm into bone bread. I think that'd be weirdly, probably high in calcium. But so first in, first out means we assume the first items of inventory we purchased are also the first that we're selling, that the first that come in are the first to go out. Okay. This especially makes sense for businesses that sell perishable goods, right? If you sell milk, what you'd like to do is always sell the first gallons of milk you bought first, so that you're always keeping a rotation. But we know, again, it doesn't happen. I know when I go to the grocery store and I'm like looking at the milk and there's a whole bunch of them there, if I see one that's got like a later expiration date, then I'll grab that one, right? Because I don't know how long it's going to take us to drink it. Now, when all 8 of my kids were home, it didn't matter. We could get 5 gallons of milk and they'd be gone in a couple of days. So first in, first out assumes the first. I like their little picture, right? They're like going in the top and coming at the bottom in order. Last in, first out assumes the reverse. It assumes that the most recently purchased goods are the first ones we're selling. Businesses that use this are often businesses that sell technology dependent things. And so, for example, if you're Apple and the new iPhone 13 gets released, they're pre-ordering for it right now, right? You're probably going to assume that when your iPhone 13 hits the market, it's going to sell before the the older iPhones that are out there. Like it's the new hot commodity, okay? And so people, I say, which cost flow assumption should we use? And I would say the best answer is, from an accounting standpoint, use the one that's most likely to mirror what's actually happening in real life. You can't know for sure for every product, but most, if it's most likely, if you're selling perishable goods and you're really trying to get people to buy the first ones, the oldest ones first, use first in, first out. If you're selling something where you really are selling the newer items before, and so the older ones are just sort of sitting on your shelves, then use last in, first out. And if you're not sure, get the average. So the weighted average, what we do is, in essence, we take the cost of everything we have in inventory right now. And if we get any new stuff, we add in that total cost, and then we just divide it by the total number of units we have, and that gives us an average unit price. So those are the three major cost flow assumptions. And then a fourth one that we're also going to talk about is what's called the specific identification method. And the specific identification method would be used in businesses, say like car dealerships, where they really can identify every item of inventory that they have, okay? A car dealership, like if you were to go over to Kempton's, maybe they have 200 vehicles on the lot. Every vehicle has a unique vehicle identification number that was put on it by the manufacturer. So they can, and I know I've seen their system, Kempton, if I go in and sit down and talk with him, he can pull up he can put in the VIN number, pull up a page on his computer that shows him exactly how much he paid for it, exactly how much mechanical work they put into it after they purchased it, or detail costs, so they know exactly what it costs them. And so on that one, they don't have to make estimates. When they sell that unit, they know they sold that unit. They can specifically identify it. And so for businesses like that, jewelers use specific identification, right? They have, it depends on the jeweler. If it's a jeweler that sells a bunch of, what's the name of those? They just sell like mass-made, like costume type jewelry and stuff. Maybe they don't. But if you're selling $10,000 diamond rings, you probably, each one has this unique serial number, okay? So those are the four cost flow assumptions. This is still not working. Maybe now? Yay. All right. So let's kind of walk through these three cost flow assumptions. It says, assume that 3 identical units of merchandise are purchased during May as follows. May 10th, we purchased 1 unit for $9. On May 18th, we purchased another unit for $13. On May 24th, we purchased another unit for $14. But they're identical in the sense that they're going to sell to the customer, and they're the same thing to the customer. Okay, so our total cost was $36, and our total units was 3. If we wanted to, we could figure out our average cost per unit just by taking the total cost divided by the total number of units. So it was $12 per unit is our average cost. Okay. All right. So assume that 1 unit is sold on May 30th for $20. We would want to ask ourselves, so what was the cost of goods sold? And if we can't tell, if we can't specifically identify which unit is, we can use one of these inventory costing assumption methods to figure it out, okay, to get at least an estimate. One of the things that probably by the end of this class that you'll recognize that maybe you didn't going into any sort of accounting is how often we're assuming things that we can't know for sure. So there's assumptions. In my mind, when I started accounting, it was like, this is like a science, man, you know everything. But a lot of times we have to say, I don't know which unit we sold. So I'm going to make an assumption. I'm going to make a guess that it was probably the first one. That's also the first one I sold, or the last one, right? And that can actually change things. When we do depreciation, which you learned a little bit about and we'll learn more about later, when we say, well, you have to take the cost of it and divide it by the useful life. What's the useful life? How long does a car last? Probably you'd say about 5 or 6 years, depending on your needs. But I mean, I drove to work today like in a 2006 car. So that's what, 20, not quite 20, 15 years old, 16 years old. So it just depends. So we have to make an estimate. How long do we keep computers for? What's the useful life of a computer? 4 years? Is it 5? Is it 3? Depends. All right. So you can see how they broke this down. If we sold the May 10th unit, let's say no matter what, we're selling it for $20. So if we sold the unit we purchased on May 10th, we would say our sales were 20, Our cost of goods sold were 9, giving us a gross profit of 11 and giving us an ending inventory of 27, which would be the $13 and the $14 unit. If we sold the May 18th unit, it's going to be different, right? Pretty significantly different, our gross profit. So herein lies the need for us to come up with a good estimate. All right, so I mentioned specific identification. If you think about it, what we did back here is an example of specific identification. If we could say we know which unit we sold, right? Easy. So that's all that means is like I explained specific identification pretty well, I think. So first in, first out. Let's take a look at that one. So this is just all the stuff I just told you, okay? All right, so let's just go through some examples. I think that will help the most. So we're gonna do, let's see, so here's our example. They call this item 127B. I don't know what it is. You can imagine whatever you want it to be. It costs $20. So we can see on January 1st, they had a beginning inventory. This was stuff that they had at the beginning of the month of 1,000 units that cost them $200 each. On the 4th, they sold 700 units at $30 per unit. On the 10th, they purchased 500 units at $22.40. 22nd, they sold 360. And the 28th, they sold 240. And on the 30th of the month, they purchased 600 more. So this, just so you know, that businesses who do merchandising, they do this all the time, right? They're buying and they're selling as a constant thing. So we would call this a period of rising costs to the seller, right? The ones they had only cost 20. Next time they bought, they were 22.40. Next time they were 23.30. That happens. Other times you have times of falling costs. All right, so there's a lot going on here. What we have on the left are the journal entries for these transactions. And on the right, what's called an inventory record. And I want to step you through it. So this first one, our assumption is first in, first out. The first units we purchase are the first ones we sell. So there's no journal entry because this is a beginning inventory, right? We didn't buy these 1,000 units during January. They were bought in previous periods of time, okay? So on January 4th, they make a sale. So you'll see that their accounts receivable goes up and their sales revenue goes up and their cost of goods sold, which is an expense, goes up and their inventory goes down. So this is the dollar amount we're dealing in. It's always, our journal entries are in dollar amounts, not in unit amounts, like what, you know. So here, though, we have to keep track of our units. So we'll say we sold a quantity of 700. The unit cost was $20. So our total cost of what we sold was $14,000. That matches up with our cost of goods sold. And then our quantity, we had 1,000 in inventory, we sold 700. So now we only have 300 left in inventory, all with the cost of $20. So the value of our remaining inventory at this point is $6,000. This is how an inventory record is broken down, okay? So then on the 10th, we purchase 500 units at $22.40 a piece. So we'll list the quantity 500 at $22.40, and then the total cost is just the quantity times the cost, okay? So then we get over here to inventory, and it's gonna show the 300 we already had, plus the 500 we just purchased to give us our total inventory. And you always keep them in order chronologically so that when you go to do the sale next time, you'll know which ones are the first ones, the ones that you're gonna sell. So the next sale we make, we're gonna say, we're gonna sell all of these 300 before we assume we sell any of the next 500, because we're doing first in, first out, okay? So on the 22nd, we make a sale of 360 units. So our assumption is we sold all 300 of the $20 units and 60 of the $22.40 units. That's going to give us our cost of goods sold, $7,344. That's what we do there. And our remaining inventory will be, we had 500. So we had 300, sold all of those. Then we had 500 of the $22.40 units, sold 60 of them, leaves us 440 units times 2240. That's the value of our ending inventory at this point. On the 28th, we sell 240 more. Well, we only have one type or one cost of inventory in inventory at this point. So we're going to assume that that all 240 were the $22.40 units. That gives us our cost of goods sold. And where we're getting this amount from is, it told us in the problem, the amount we sold each unit for, okay, it was 30 bucks, I think. And then our remaining inventory, if we had 440 and we sold 240 of them, we have now 200 units left in inventory. On the 30th, we purchased 600 more units at $23.30 a piece. So now we have a total of 800 units, and our total cost of the units was $18,460 sitting in inventory at the end of the month that will now become our beginning inventory at the beginning of next month. So that's an inventory record, and that's how the transactions flow using first in, first out. All it means when we say we're using first in, first out is we're going to assume the oldest units get sold first. That's all. Like, don't make it more complicated in your head than that, okay? So it only comes up. The other thing is people get all freaked out whenever there's a purchase. They're like, I don't know what to do. A purchase doesn't impact anything other than it just gives us more units to add, okay? So the only time we have to worry about the whole first in, first out, or last in, first out thing is when we make a sale. Because all we're saying is when I make the sale, I'm saying, which units did I sell? First in, first out, I sold the oldest units first, okay? All right, so here's the same set of transactions, but now using a last in, first out assumption, okay? So again, we start with 1,000 units that we paid $20 a piece for. We sell 700 units. Again, this actually is identical to first in, first out because we only had these units. So there's no question of which units did we sell here. We only have units with a cost of $20 a piece. So we sell 700, $20 a piece. Our total cost was $14,000, which will be our cost of goods sold on the transaction. We have 300 remaining. Then we make a purchase of 500 at $22.40 per unit. So now we have $320 units and 2240 units. So our next transaction is we're going to have this whole last in, first out issue come into play. I sell 360 units. And the question is, which units did I sell? And the answer is the ones that cost $22.40. Why? Because they're the last ones in. They're the most recently purchased units. So I sold 360 units. They were all $22.40 units, giving me a cost of $8,064. That'll be my cost of goods sold. And so my remaining units are now still the 300 units I paid $20 for, or that I had from remaining inventory, plus 140 of the $22.40 units. Okay, on the 28th, I make another sale of 240 units. Again, which units am I selling? My assumption is I'm going to sell the oldest, or I mean the most recent units, last in, first out, first. So I sold all 140 of those, plus 100 more of the older units. Again, does this mean I actually sold the newer units of the older units? It doesn't. It's an estimate, an assumption, a guess, right? And so we don't know which units we sold, but our assumption is that we sold the oldest units, I mean the most recent units first, because we're on last in, first out, and then the older units. That leaves us with 200 units, and those 200 units all had a cost of $20. Those are the first units we had at the beginning. Then on the 30th, we buy 600 more units for $23.30. So that leaves us at the end of the month with $220 units, $623.30 units, and then a total cost of $17,980. So what you'll find out is at the end of the month, the number of units will be the same regardless of the cost flow assumption you use, right? Before we had 800 units left with first in, first out, and with last in, first out, we also had 800 units left. But our cost is going to be different because we made some assumptions about which units. So when we use first in, first out, it was 800 of the most recently purchased units that were still left there. But under last in, first out, we had these old units because they never got sold according to our assumption. This is one of those things that if you take it step by step, line by line, pretty easy. If you start trying to think too globally, it gets really confusing really fast. which you probably have noticed, like that's accounting in general. You almost have to like force yourself to stay narrow and look at it. You know, if you want broad thinking, like take a literature class or something, I don't know, but here we're narrow thinkers. We refuse to see things. One time my boss was like, why are you always fixated on money? I'm like, because the last 20 years of my training has forced me to fixate on money. Like that's my job, right? That's such a narrow way to view things. Well, I'm sorry. The world needs people like me. It also needs big thinkers, right? We need both. Someone's got to count the beans, all right, or spill the beans. I don't know what you do with beans. All right, weighted average. So same idea. We started with 1,000, cost us $20 a piece. On the 4th, we sold 700. Again, whenever we only have units of a single cost, there's not really any question of which one we sold, so that makes it easy. Sold 700 at a cost of $20 a piece, and so we're left with 30 at 20. Then we purchased 500. So now, if you remember on first in, first in, and last first in, first out, and last in, first out, we had like listed, we kept them separate, right? When we do weighted average, what we're going to do is we're going to say I had 300, I purchased 500 more, so now I have 800. And my cost, the ones I had were the cost 6,000. The ones I purchased cost 11,200, so I take 6,000 plus 11,200. That would give me the total cost. Then I would just take the total cost, divide it by the quantity, and that would give me the new average cost. So that's what's different about this one. We don't keep them separate. Instead, we put it all together and we calculate an average cost, okay? So then when I make a sale, I just use this average cost. So on the 22nd, I sold 360 units at an average cost of $21.50 a piece, which gives me a cost of $77.40. That leaves me with 440 with an average cost of $21.50 a piece, which means the value of those is 9,000, or the cost of those is 9,460. On the 28th, I sell 240 more, still at an average cost of $21.50, and I still have 200 remaining at $21.50. And on the 30th, I purchase 600 more, so I take the 200 plus the 600, gives me 800 total units. I take the 4,300 plus the 13,980, gives me a total cost of 18,280. Divide 18,280 by 800 to get a new average cost, and I use that one. So with weighted average cost, all we do is each time we make a purchase, we recalculate our average cost, and then each time we make a sale, we use that average cost to figure out not only what our cost of goods sold was in the sale, but also what's the value of our remaining inventory. And we keep using that average cost until there's another purchase. Then we use that to recalculate the average cost, okay? Again, if you just do it step by step, not too bad. Okay. So that was, all of that was being done in a perpetual inventory system. And if you remember, what we mean by perpetual inventory is that we sort of keep track of our cost of goods sold with every sale, and our change in costs with each purchase. Like it's an ongoing perpetual situation. We're tracking that as we go. Not all businesses use a perpetual system. Some use what's called a periodic inventory system. So when we're using a periodic inventory system, then whenever we make a sale, all we do is we record our revenue. We're not going to calculate cost of goods sold until the end of the period, okay? So no entries made at the time of sale to record cost of goods sold. At the end of the accounting period, a physical inventory is taken to determine the cost of the inventory and the cost of goods sold. But we still apply these cost flow assumptions. So I'm going to step you through that process. So recognize that when you face a problem, especially in real life, you know exactly what method you use in your business, or, you know, but in a book problem, you have to figure out, first of all, wait, is this am I using a perpetual or a periodic? The good news is they always tell you, because there's really no other way for you to know. They'll tell you this business uses a perpetual inventory system, or this one uses a periodic inventory system. But that's the first thing you have to delineate, because it's going to change how you approach the problem. All right, so here's the business. We see that this is again the same exact example. They had 1,000 units of inventory that cost them $20 at the beginning of the period. They made a purchase of 500 at 22.40 on the 10th, and another purchase of 600 units at 23.30 on the 30th. So what we like to do is add this up and say, we had 2,100 units available for sale during the month, and the total costs of goods available for sale was 45,180. So this is how we deal with this in a periodic system. All right. So with the first in, first out method, what we're going to do is we're going to say, we know what our beginning inventory was. We know what our purchases were during the month. That gives us the cost of goods available for sale. Then they take a physical inventory, and it will actually tell you. Oh, it doesn't tell you here. And the problem, it will tell you that, oh yeah, it does say the January 31st inventory is 18,460. So in real life, the way this goes down is at the end of the month, somebody goes there and counts up all that inventory and says, this is how much inventory we have sitting there now. So if you know how much you had at the beginning of the month, and you know how much you purchased during the month, that gives you cost of goods available for sale. And then you count it all up and you know how much you have at the end of the month. If you subtract what you had available from what you have at the end of the month, that gives you the cost of goods sold. Okay. And so that's how we do things in a periodic system. And how did we figure out this number, the value of our ending inventory? Well, we used, in this case, it was first in, first out. So we assume that if we have this many units of the product available, we multiply that by the later costs, right? Because so we're assuming that we sold the earlier units and that we still have left in inventory are the most recently purchased units. That's how we calculate this. So someone counts up, there's this many units sitting there. We go back and look at our purchase logs and we can say, okay, we're assuming this is the most recently purchased units that's still here under a first. So under a first in, first out method, recognize that we're assuming that the last in units are the ones still sitting on the shelves because the first in units were the ones that were sold. Okay. On a last in, first out, we do the whole same process, except when we're making the estimate as to which units are sitting there, we're assuming it was the first in units that are still present because the last in units were the first out. Okay. And then with weighted average, we come up with an average cost per unit and we multiply that out by the number of units sitting there in inventory at the end of the month and calculate it. Okay. So again, a lot of these things are actually way easier in real life because you know what you're looking at. Whereas in class, it's like a word problem, right? And everybody hates word problems. And so just recognize that if it feels hard here, it's actually easier in real life. So often in real life, if I have an accounting issue I'm working on, I can just walk down to the management, the operations manager or the sales manager and say, hey, I have a question about these numbers. Where are they coming from, right? In a book, you can't always do that. So sorry. All right. Another couple rules here. Typically, on our balance sheet, we carry our inventory at its cost, but there is financial conservativity, yeah, something like that. Being conservative in our estimates of what stuff's worth dictates that if our inventory drops significantly in value, that we should probably adjust our books to the lower of the cost or the market value. So again, think of something that's really sensitive to changes in the market. We'll go back to iPhones. So, I have an iPhone 10, right? Because I'm old school, I guess. And the iPhone 13 is coming out. Probably the secondary value or market value of this iPhone 10 is going to drop when the iPhone 13 comes out. Okay. And so if I'm a store and I've got a bunch of these sitting on my shelves and the iPhone 13 comes out, and now the market value, instead of these being worth $700 a piece, drops to $500 a piece, it wouldn't really be fair to my investors to show them on my books as being worth $700 when I'm never going to get that for them. Does that make any sense? So what we'll do is we'll make an adjustment to the lower of cost or market. When we say market, we mean not what we could sell them for, but what we would be able to replace them for from the supplier, because we're dealing in costs, not in retail price. So anyway, you just need to know that, and there'll be a problem or two where it'll say something like you have this much sitting in your inventory and the new replacement value of it is this much, right? And so what you have to do is adjust that. No problems. All right. So you've already seen this, but I just want to show it to you one more time. Merchandise inventories sit on your balance sheet in the assets section, and they're current assets. By current assets, we mean assets that are either cash or cash equivalents, or are readily convertible to cash, meaning we think that we're going to convert those to cash within the next year or so. Certainly that's our goal, right? Is to sell our inventory and turn it into cash. So that's where it's going to sit. And recognize now that since we've just learned these different methodologies for making an assumption about how much our remaining inventory is at the end of the month, that assumption is actually going to impact our balance sheet, right? It's also going to impact our income statement, because that assumption also plays into our cost of goods sold figure. And our income statement impacts our net income, and our net income impacts our taxes. So the IRS has a sort of vested interest in making sure you're being consistent and fair in the assumption you use, okay? Usually the IRS says you're free to use whichever assumption you want, first in, first out, last in, first out, weighted average, or specific identification, as long as you consistently use that. Like, you don't try to change it each time you think you'll gain some advantage by doing it, and as long as you could justify a change if you do need to make it. So if your business changed significantly and now a weighted average would just make more sense than what you've been using first in, first out, you're allowed to change. You just have to be able to justify it to the IRS, saying this is why we're doing it this way. And the SEC, Securities and Exchange Commission, so they're the ones who handle the legal trading of your stock and stuff like that. If you're a big publicly traded company, they're also going to want to know, why are you changing this? Because if you're just changing it so it looks like you had more profit than you did, that's not an okay reason. If you're changing it because the way you manage inventory has changed and now you're able to specifically identify each unit you sell, well, then that makes sense. Of course you would change it that way. So recognize that this, all of financial accounting that we've learned about so far is really just our ability as a company to communicate what's happening financially in our company to external users by creating these financial statements that have a very consistent look and feel. Okay, so the most common external users are investors, people who would be buying stock in our company or investing in our company in some way, lenders, and government entities who have some regulation duties, whether it's the SEC or whatever. Okay, so that's why we do all of this, is so that we can have a uniform way of reporting this information to the external users. The next class you'll take is managerial accounting, and it's not so rigid. Why? Because now we're gathering and figuring out data for use in decision making, and we don't have to use the same form as every other company. Instead, we need to figure out what's the most important way to look at our data to make our decisions internally. Okay, couple of ratios they give you in the analysis and decision making section of this chapter. The first is called inventory turnover, and it's a measure of how quickly we are selling our inventory. Generally, the larger the inventory turnover, the more efficient and effective the company is in managing inventory. So we're going to take our cost of goods sold, and we're going to divide that by our average inventory. Anybody know how to calculate average inventory? You saw something like it from the last chapter where you had to do an average. I forget what it was. One of these. So recognize this. Cost of goods sold is an income statement account. It's an expense. It gets reset back to zero every month, right? So it covers the amount of our cost of goods sold expense for the period of a month or a year or whatever we're calculating for over time. But inventory Doesn't. Inventory is a balance sheet item. It's an asset, okay? And so we can't just compare a whole month's worth of cost of goods sold to an asset at a given period of time. So instead, what we do is we average that asset over that period of time. So what we would do is take the average, or take the inventory at the beginning of the month, plus the inventory at the end of the month, divided by 2, and that'll give us an average across that month, okay? Now, could we get, if we had good data on what our inventory was each day, at the end of each day, and we added all of those up and divided by 30, would that give us a better, a more precise average inventory? Sure, it would. But most of the time, we just don't have that data. You know, people, especially people who do like periodic, they usually do the inventory once a month or once a quarter. So all you can do is say, here's what it was at the beginning, here's what it was at the end, add up, divide by 2. So to find our inventory turnover, we're going to take our cost of goods sold divided by our inventory at the beginning of that financial period, plus our inventory at the end of that financial period, divided by 2. And that's going to tell us, if you think about it, what is our cost of goods sold as a percentage or ratio of our average inventory. So if this came out to be 1, okay, it would mean our cost of goods sold for the period equaled our average inventory for the period, meaning we sold an amount equal to everything we have on hand. We sold a whole store's worth during the period. Does that make sense a little? Now, it doesn't mean we sold every item in the store. We may have sold some items 3 times over and replaced them, and other ones are still sitting on the shelves from the beginning. It means a value or a cost to us. So that is turnover. The higher, the better, typically, okay? The other one is what's called days sales and inventory, or number of days sales and inventory. We always call it days sales and inventory, DSI, where we take our average inventory and then we divide it by our average daily cost of goods sold, okay? And that's going to tell us, on average, how many days something stays in inventory until we sell it. Again, it doesn't speak to a specific item of inventory. It speaks to an average dollar of inventory. If you think about it, if we go back here, give our cost of goods sold and our average inventory. So if that's 1, and this is for a month, then this is going to calculate out to 30, actually, right? That on average, it takes us 30 to sell, 30 days to sell inventory. So in this case, lower is better. The faster we sell it, the lower this number will be, okay? All right, so here's an example. Oh, we didn't have the numbers, but it's just comparing two to each other. So Best Buy's inventory is 5.9. Whole Foods is 21.2, okay? And so Best Buy's, it takes them on average 61.5 days to sell a piece of inventory. Whole Foods takes 17.2 days. So I think these are a couple of interesting companies to compare. What does Best Buy sell? What's that? Yeah, mostly like home electronics and stuff like that, right? Computers and TVs and stuff like that. And Whole Foods sells food, right? So you would hope Whole Foods would have a quicker turnaround. The other thing is, I don't know, but I'm guessing the average item of inventory, if we average the whole store of Whole Foods, is, you know, $3 or $4, because they have, you know, under $1 things to buy all the way up to more. But I'm guessing the average inventory unit at Best Buy probably costs, you know, $400 or $500 or something or more. So again, these are silly ones to compare because of course they're going to be different. I'd be more interested in comparing, say, like Whole Foods, who has this sort of like, I don't know, a less pushy vibe and more chill vibe about it, to something like a more traditional supermarket, and saying, does their vibe slow down their sales like the way they're, you know, or not? That might be an interesting thing to compare. All right, I think that's it for this chapter. So hopefully this is fairly easy for you compared to some of the others. But I run through it pretty fast? Not that fast, I guess, about the same. Any questions? I know that style of lecture doesn't leave any room for questions. We just go through it. Questions happen tomorrow, right? As we do a group work. All right. Have a great day. Be kind. Remember who you are and make good choices. Any other things I can say to you? Be happy. Choose happiness, Elisa.